Achieving unstoppable profits requires mastering the art of the exit, specifically by identifying the precise moment large operators liquidate their positions at the market top. This crucial skill is not about guessing when a stock is high, but about systematically recognizing the forensic evidence left behind by professional selling, known as the distribution schematic. This schematic, pioneered by Richard Wyckoff, provides a roadmap for understanding the transfer of stock from the knowledgeable, strong hands to the reactive, uninformed, weak hands of the public. By recognizing this pattern, traders can secure maximum capital protection and capture the final profits before the inevitable and often devastating markdown phase begins. The primary purpose of the distribution schematic is to allow institutional players to unload massive quantities of shares without crashing the price prematurely. They need a prolonged period of apparent strength and excitement to attract sufficient retail demand to absorb their selling volume. Our goal as informed traders is to identify the exact point where these large operators have completed their liquidation, thereby confirming the market's internal weakness. Missing this signal means holding through the subsequent crash, turning paper profits into painful losses. Richard Wyckoff observed that controlled selling is characterized by the market's inability to sustain rallies, even when accompanied by high volume and widespread bullish sentiment. He noted that the excitement generated by news or rumors often coincided precisely with the periods when institutions were quietly exiting. This fundamental insight allows us to move beyond simple price action and analyze the underlying supply and demand dynamics, which are the true drivers of market direction. Utilizing the distribution schematic transforms capital protection from a defensive measure into a mechanism for securing unstoppable profits by ensuring we exit near the peak. Before we dive into the technical phases that define the market top, please take a moment to subscribe to the channel and leave a quick comment below. Even just a single word or a simple thought about the Wyckoff method greatly helps the algorithm recommend this video to more serious traders. This simple action shows me that this kind of detailed, practical content truly matters to you and is worth the extensive effort required for its creation. Remember to return to this channel during challenging times, especially when trading becomes difficult and your confidence starts to waver, as we are here to provide clarity and structured guidance. The distribution schematic is fundamentally a psychological battle played out on the price chart, where professional money systematically tricks the public into buying shares at inflated prices. This transfer process is lengthy, deliberate, and leaves distinct footprints that Wyckoff codified into 5 measurable phases. If you learn to read these footprints, you gain the ability to anticipate major trend reversals, which is arguably the most valuable skill in trading. The schematic provides a high-probability framework for exiting long positions or initiating short sales when the risk-reward ratio is most favorable. It moves us away from emotional decision-making and anchors our actions in objective, observable market behavior. Understanding the distribution mechanism begins with acknowledging that professional money cannot simply dump millions of shares instantly without collapsing the price. They must create an illusion of strength and stability, often using positive news flow and high-volume bursts to mask their true intention. Therefore, distribution occurs within a defined trading range, where sellers are active on the high end and buyers are fooled into supporting the low end. Our primary objective is to recognize the moments when supply overwhelms demand and the trading range structure itself begins to break down. This realization is the key to transforming theoretical knowledge into practical, profitable action. The core principle that Wyckoff identified relies on the failure of the market to make sustained progress despite significant effort. For instance, a stock might see massive trading volume, indicating high effort from both buyers and sellers, but the resulting price gain is minimal or non-existent. This poor result relative to the expended effort signals that large operators are actively absorbing the buying pressure, preventing the price from advancing further. This divergence between volume and price progress is the first tangible evidence that distribution is underway and that the underlying trend is reaching a point of exhaustion. This controlled selling process guarantees that the large operators secure maximum profit before the inevitable markdown begins. By exiting near the top, they preserve their capital and are positioned to re-enter the market at significantly lower prices later on. Conversely, the uninformed public buying into the excitement secures maximum loss as they hold the bag through the ensuing crash. The distribution schematic is therefore a powerful tool for self-protection, ensuring that you are aligned with the knowledgeable professionals, not the vulnerable public. Phase A, early warning signals and exhaustion of demand. Phase A marks the initial stopping of the prior upward trend and presents the very first clues that supply is entering the market. The most critical event here is the preliminary supply, which is the first clear surge of heavy volume after a steep and prolonged rise. This volume surge signals that professional selling pressure is starting to enter the market, attempting to slow the pace of the advance. While the price might still make new highs, the intensity of the buying is now being met by equally intense, albeit hidden, selling. The preliminary supply often appears as a wide-ranging bar or candlestick, but the key feature is the sudden and significant increase in turnover compared to the preceding bars. This event indicates a crucial shift in the supply-demand balance, where the momentum of the upward trend is visibly losing its strength. Traders must recognize this high-volume signal not as a sign of continued strength, but as a potential warning that the trend is becoming exhausted and vulnerable. This initial selling pressure lays the groundwork for the more dramatic events that follow. The buying climax is the next and usually most spectacular event in Phase A, marking the true high point of the distribution range. This event is characterized by a dramatic price surge on exceptionally high volume, often driven by frenzied emotional buying from the public who fear missing out. The buying climax is where the last desperate buyers enter the market, providing the liquidity necessary for the largest operators to complete a significant portion of their selling. This event often generates headlines and extreme optimism, making it a classic trap for latecomers. Following immediately after the buying climax is the automatic reaction, which confirms the intense supply present and establishes the lower boundary of the distribution trading range. The automatic reaction is a sharp, swift reaction downward from the peak, often occurring on high volume as sellers assert immediate control. The speed and distance of this reaction, particularly relative to the volume seen at the buying climax, are crucial measures of seller conviction. If the reaction is deep and rapid, it confirms that supply has decisively entered the market and that the upward movement is definitively halted. The distance and speed of the automatic reaction are practical details that cannot be ignored when analyzing the schematic. A deep automatic reaction indicates that the professional selling was aggressive and highly committed, establishing a wide, vulnerable trading range. The low point of the automatic reaction becomes the critical support level, which Wyckoff termed the creek or ice, and the subsequent inability of the market to reclaim the buying climax high confirms that the market is now operating within a range defined by intense supply. Phase A thus transitions the market from a clear upward trend into a volatile sideways distribution zone. Phase B, building the cause and trapping. Late buyers. Phase B is the longest and most complex phase of distribution, serving the critical function of allowing large operators adequate time to sell their massive holdings without collapsing the price. This phase involves numerous price swings, testing both the high resistance and the low support established in Phase A. The market is effectively building the cause, which is the necessary period of sideways accumulation of supply that will lead to the effect, the subsequent markdown. During Phase B, the market appears choppy, frustrating both bulls and bears, which is precisely the environment institutions need to execute their selling. The primary characteristic of Phase B is the testing of demand and supply within the established trading range boundaries. Price movements test the highs established by the buying climax, but critically, they often fail to reach or penetrate that high significantly. Each rally that fails to make new, sustained highs is evidence that supply remains dominant and is absorbing any renewed buying interest. These tests are essential for the large operators to gauge remaining demand before committing to the final markdown. Identifying traps is crucial during Phase B, particularly the event known as the upthrust. An upthrust is a brief penetration above the resistance area of the trading range, designed specifically to trap short sellers who might be betting against the market, and simultaneously to encourage breakout traders to enter long. This false signal is quickly reversed, with the price snapping back into the established range, confirming that the move lacked genuine buying support. The upthrust is a classic manipulative move, designed to shake out weak hands and gather liquidity for the institutions. Analyzing effort versus result is the core tool for navigating Phase B successfully. We must observe rallies that occur on high volume, representing significant effort from buyers, but result in minimal price gain or immediate reversal. This poor result relative to the high volume proves conclusively that supply is actively absorbing all available demand, confirming the distribution process. Conversely, down moves that occur on increased volume and result in sharp price declines further confirm the underlying weakness. As Phase B progresses, we look for a critical sign of weakness, which is a drop toward the lower end of the trading range, often accompanied by increased volume. This event confirms that supply is decisively winning the battle and that the market is struggling to hold support. While the sign of weakness might not break the established support level, its presence indicates a shift in momentum, confirming the vulnerability of the market structure. This initial strong move down prepares the market for the final manipulative acts of Phase C. Phase C, the ultimate exit trigger, upthrust after distribution. Phase C is the decisive, final test designed to confirm that virtually no significant demand remains in the market. It represents the last major manipulative action before the markdown begins, and it is arguably the highest probability point for the informed trader to exit or initiate a short position. The purpose of Phase C is twofold: to shake out any remaining weak hands who bought the dips within the range, and to confirm the viability of the short side by forcing a final, failed rally. Understanding this phase is the difference between exiting early and exiting optimally. The most important event in Phase C is the Upthrust After Distribution, often abbreviated as the Upthrust After Distribution, which serves as the ultimate exit trigger. This event involves a clear penetration of the buying climax high or the resistance established by prior upthrusts, effectively fooling the maximum number of participants. It looks like a genuine breakout, convincing the last remaining skeptical buyers to jump in, believing the correction is over. However, this penetration is manipulative and lacks the sustained follow-through required for a true reversal of the distribution process. Specific analysis of the upthrust after distribution reveals its manipulative nature. It often occurs on reduced volume compared to the initial buying climax, indicating a lack of genuine institutional participation. The price quickly fails to hold above the resistance level, rapidly reversing back into the trading range, trapping those who bought the apparent breakout. This failure confirms that the distribution is complete, as the large operators have successfully used the final burst of enthusiasm to offload their remaining inventory. The immediate action required upon identifying the failure of the upthrust after distribution is crucial. This event represents the highest probability point to liquidate all remaining long positions. For aggressive traders, this is also the optimal point to initiate a profitable short position, as the subsequent markdown is highly likely and imminent. The quick failure of the rally following the upthrust after distribution proves that the move was purely manipulative and lacked any underlying demand, sealing the fate of the market. If the upthrust after distribution is missed, the trader has lost the optimal exit point. But the overall schematic still provides structure for subsequent actions. The key takeaway from Phase C is the absolute confirmation of the market's internal weakness, signaling that the extended period of selling by professionals has concluded. The market is now poised for a sustained decline, having failed its final test of strength. Phase D, confirmation and final execution, last point of supply. Phase D provides the concrete confirmation that the trend has reversed and that the markdown is now beginning, transitioning the market from the sideways distribution range into a downward trend. The critical breach that defines Phase D is the market breaking below the support established by the automatic reaction and previous signs of weakness. This support level, often referred to as the ice or creek, represents the lower boundary of the distribution range, and its decisive break signals the end of the manipulative phase. When the market breaks the ice, the selling pressure accelerates, confirming the dominance of supply and the start of the markdown. This breach is often accompanied by a significant increase in volume and wide price spreads, indicating panic selling from those who bought within the trading range. The break below this critical support level confirms the fundamental shift in market structure from distribution to decline. This event serves as a final warning for any traders who may still be holding long positions. Following the critical breach, the market will typically perform a counter-trend rally known as the last point of supply. This event is vital for traders who missed the upthrust after distribution exit point, as it provides a second, slightly safer opportunity for execution. The last point of supply is a rally that returns to test the broken support level, which now acts as a confirmed resistance level. This test proves whether the broken level is truly resistance or if the market can reclaim the trading range. The execution method at the last point of supply requires careful volume analysis. The counter-trend rally must occur on low volume, indicating that there is no genuine institutional interest in buying or supporting the price at this higher level. If the rally occurs on high volume, it suggests a potential failure of the distribution pattern, but low volume confirms the move is purely technical and corrective. The inability of this rally to reclaim the broken support level confirms the complete dominance of supply and signals the immediate start of Phase E, the sustained markdown. This last point of supply offers a defined low-risk entry point for short sellers and a final opportunity for long holders to exit with minimal loss. The failure of the market to push back above the broken support confirms that the path of least resistance is now definitively downward. Phase D thus solidifies the reversal, moving the market structure from a battle zone to a confirmed decline. Mastering the distribution schematic provides traders with a systematic, high-probability framework for exiting the market near its peak, securing those unstoppable profits. The entire process hinges on the forensic analysis of volume and price action, moving past the emotional noise generated by market exuberance. The schematic forces the trader to view the market through the eyes of the professional operator, recognizing manipulation and acting before the crowd. This methodical approach is the hallmark of successful long-term trading. We can synthesize the knowledge gained into three primary, actionable exit strategies that correspond to different phases of the distribution process. Exit strategy. One involves exiting partial positions near the initial buying climax and subsequent upthrust area. This is a high-risk, high-reward strategy that capitalizes on the initial peak but requires aggressive execution and acceptance of volatility. It is best suited for traders looking to scale out of their positions gradually as the distribution progresses. Exit strategy. 2 represents the optimal exit point for the majority of positions, liquidating immediately following the failure of the upthrust after distribution in Phase C. This strategy offers the best balance of maximizing profit while minimizing exposure to the final manipulative trap. The confirmation of the upthrust after distribution failure provides the clearest signal that the institutional selling is complete and the markdown is imminent, making it the highest probability exit point. Exit strategy 3 offers a confirmed risk management exit, involving liquidating the final positions upon the confirmation of the last point of supply in Phase D. This exit is safer for those who missed the earlier signals, but results in a slightly lower exit price as the market has already broken significant support. It is a robust method for confirming the trend reversal before the deep decline accelerates. The absolute necessity of volume analysis cannot be overstated, as distribution is confirmed by specific volume characteristics that contradict healthy market behavior. Specifically, distribution is confirmed by increasing volume on down moves, indicating aggressive institutional selling, and decreasing volume on rallies, showing a lack of genuine institutional buying interest. if rallies occur on heavy volume but fail to make sustained progress. This effort versus result divergence is a definitive sign of supply absorption. Reviewing the schematic sequence is the final practical step to embed this knowledge into your trading routine. The sequence moves from the spectacular high of the buying climax through the manipulative testing of the upthrust and signs of weakness to the decisive failure at the upthrust after distribution, and finally to the confirmation at the last point of supply. Recognizing this predictable sequence guarantees that you can secure your profits and exit near the peak, avoiding the catastrophic losses that follow every major market top. This structured approach provides clarity and confidence, even in the most volatile market conditions. If you seek to deepen your understanding of these timeless principles and integrate Richard Wyckoff's proven methods into your daily decision-making, we highly recommend exploring his core work. The adapted edition of his classic treatise, How I Trade and Invest in Stocks and Bonds, is an invaluable resource that systematically unveils his time-tested methods for market analysis. This work details exactly how to determine the intentions of large players and how to make informed trading decisions based on verifiable market structure. By studying Wyckoff's original insights, you can transform theoretical knowledge into consistent, predictable results, ensuring you always align your capital with the market's true power players. Follow the link provided in the description below to secure your copy and begin your journey toward truly professional market mastery.